All right. Hello, good morning, everyone. Good afternoon, I guess, to some of you out there, wherever you are in the world. Welcome to the webinar here today. Today, we're going to go over the Nadex knockouts and call spread contracts. So, gonna have a good one here for all of y'all today. I do see some more people filing in as we get started. So, hopefully, we get a few more as we get in here. But I will go ahead and kick it off for all of you people that did get here right on time today. Real quick, we're going to go over a couple things really quick at the beginning, some sort of, I guess, housekeeping things. If you do at any point throughout the webinar have any questions, anything like that, I have the kind of questions chat up on the other screen here, up on the left-hand screen. So I will be looking at those as we go through the webinar. If you do have any questions, I'll do my best to get to them in real time, or alternatively, you can always hold the questions to the end, and we will have a little bit at the end there to answer any questions you do have. So move right into this. This is our great disclaimer we have here. This is shouldn't be new to anyone that's been on any Nadex webinars before, but I'll give everyone a chance to read through it here just for a second. Very basically, what it says is trading at Nadex and trading really anywhere is going to involve risk, right? You need to know that there is risk involved in any trading anywhere, and if people ever tell you there's a riskless trade, well, definitely double check that because there's not very many things in life that are truly riskless. So yeah, you want to be trading with money that you can't afford to lose potentially if things don't go the way that you think they will. So you don't want to be trading with rent money, food money, money you need for something else. You want to be trading with that discretionary income, right? Also, I will be going ahead and placing some trades on the platform here today to basically show all of you the functionality of knockouts of call spreads. Those are basically going to be chosen at random just to show the functionality. It's not a recommendation of any trades to make. And in fact, I will be, as I said, picking them basically at random. So please do not follow the specific trades that I make and think they are any kind of recommendation or good trading advice, because it will be just to show the functionality of the platform. All right, I think we've spent enough time on this slide here. There we go. Now I think I'm inundating your screen a couple times with my webcam and this picture of me. Real quick about me, I've been working at Nadex since 2017, so about 5 years now. I've been focusing on the products and our platforms for the last 4 years or so. So a lot of the new products that have come up in the last 4 years, and as well as the new platform, or I guess at this point it's a couple years old, but was heavily involved in creating and putting all of those up. So that's why I like to give these webinars. I can give a little background about maybe some decisions we made on why we do certain things with the products with the platforms. In my own personal life, I trade mostly equity and equity options. I can't trade on Nadex because no Nadex employees are actually allowed to trade on the exchange. You're never trading against a Nadex employee when you are trading here. So yeah, that is my personal trading experience. All right, let's jump into the actual fun part of the webinar, the nitty gritty, the actual content. So real quick, we have an agenda. Basically what we're gonna do here today, we're gonna keep it kind of a little bit light, a little bit casual, but we are gonna hit on some important points. So we're gonna go through knockouts, we're gonna go through how they work, what the risk, the reward, the capital requirements, try to get down into both the basics, but also a little bit touch on some concepts that I think people call more advanced sometimes, but I think everyone on this webinar is bright. So we'll go into some concepts that might be a little bit more advanced, but we will also hit on the basics pretty hard as well. Go over why you might want to trade a knockout as opposed to a call spread, what the similarities between the two contracts are, what the differences between the two contracts are, and then at the end I am, or actually probably with maybe 15 minutes left or so, I'm going to jump to the platform. We're going to go through actual live examples on our demo environment. We're going to go to the demo. We're going to trade some call spreads. We're going to trade some knockouts, and we're going to see how they work in a real demo environment. So getting into them, what are knockouts? What the hell is a knockout contract? So a knockout contract is basically going to be a derivative contract, as all Nadex contracts are, that trade within a set price range. So basically, there's going to be two levels to this price range. You're going to have a floor price, the low price, and you're going to have a ceiling price, the high price, right? Your trade is going to exist in between these two prices. You're never going to go above the ceiling in a trade, and you're never going to go below the floor in a trade, right? So fairly simple in that regard. Between the floor and the ceiling, the contract is generally going to move in line with the underlying market, and the knockout contracts are, they are derivative contracts, so you're not actually trading the underlying market, but with the knockouts in particular, they are very good at tracking that underlying market nearly one-to-one, right? It gets close to that one-to-one where you are actually going to have the bid and the ask a little bit off, but you're going to have fairly tight spreads moving right around where that underlying market is moving in most cases. And really same as any market, both off Nadex and on Nadex with the binaries, with the call spreads. If you think that the market is generally going to go in an upward direction, you want to buy that contract. And if you think it is going to go in generally a downward direction, you want to sell that contract. So you can both take the upward position and the downward position in these contracts. And again, that's the same across all Nadex contracts, whether it be the binary options, whether it be the call spreads. You can go basically take a long position or a short position. So how do these things expire, right? How do these end? Because these are, they're not sort of perpetual contracts. They do have a sort of set defined range, just like all of the contracts on Nadex. So there's one of two ways that a knockout contract can actually go ahead and expire. They're either going to expire by sort of a price triggered settlement or a time triggered settlement, right? They're either going, basically what this means in very simple terms, it's either going to expire by hitting the floor is down here, hitting the floor, hitting the ceiling, right? So that's a price triggered settlement. If the price goes up and hits or goes above the ceiling, or hits or goes below the floor, that's going to result in a settlement of the contract. It's going to close the contract, and both parties to that contract will get their payout, right? The other way that a knockout contract could settle is going to be a time-triggered settlement. So if you do get into a knockout contract, all of our knockout contracts are going to expire on Fridays, right? So the longest duration you're going to be able to have is sort of a weekly contract. If you get into that contract and it does not hit the floor or does not hit the ceiling, right? It just kind of trades between that range for the entirety duration, and then it gets that end time, then you're going to get the second kind of settlement, which is called a time triggered settlement, right? Which basically just means it hasn't hit the floor, it hasn't hit the ceiling, it just gotten to the end of the contract kind of over here. So you sort of, I know I'm just doing this with my hands here, and we will have better non-hand diagrams a little bit later in the webinar, but basically what you have is sort of a three-sided box right here, where you can think of the floor here, the ceiling here, and on this side, sort of the time, the other side of that box. And if it hits any of these three sides, it's going to go ahead and settle that contract at that point. And so, like I was sort of saying in the last slide a little bit, I get ahead of myself in a lot of these slides because I just love talking about these things, but each knockout is going to have a maximum duration of 1 week, right? So at the beginning of every week, generally on Monday morning is when we most of these actually get up and get listed on the exchange. There's going to be 4 knockout contracts for every market that you can trade these in. And just as a bit of a tangent, these knockouts are available in all asset classes that we offer on Nadex. So you can trade knockouts on Forex, you can trade knockouts on commodities, you can trade knockouts on indices. It's not every single market we offer, but it is most of our big markets we offer the knockouts on. So again, you're going to have them begin on Monday. They're going to go through Friday, right? That's going to be the duration, kind of the maximum duration of a knockout contract. And at the beginning of the week, in each market that is available, you're going to have 4 knockout contracts. And generally, you should always have 4 knockout contracts, because how the knockouts work is when a knockout goes down and either hits the floor or hits the ceiling, at that point, that knockout will be knocked out, right? So if it touches floor or ceiling, it'll expire at that point, and automatically the exchange will list a new knockout either above in the case of a ceiling knockout or below in the case of a floor knockout. So basically, there will always be 4 knockouts listed, or should almost always be 4 knockouts listed on every single asset class or every single market, because as soon as one ends, another one just automatically comes in, right? So you're always going to have, or should always have, because you kind of have 4 offset, and we'll see this in a slide in a second that shows it better in a diagram, but because you do have these 4 kind of offset ranges, you should always have something that, the market's trading somewhat close to the top, somewhat close to like the middle of the range, a little bit higher than midpoint, a little bit lower than midpoint, but something close to kind of the bottom of the range. So you should be able to always get in with a contract that lets you sort of take the amount of risk that you'd like to take on. And again, we'll talk about that sort of risk and reward proposition a little bit later in the webinar here. So I think up next, we have basically an example. So this is sort of what I was talking about just a second ago with these 4 sort of ranges, right? So you can see how they're sort of just offset, and you always have, they just kind of go down like that, right? So in this example, we have a gold contract. We're using gold for this knockout example, and the market in our example here, and actually you can kind of see right over here. I should maybe make this slide a little bit clear, but you can see a little bit of a market right there. So in this scenario, gold is trading at 1820. And so basically how the knockouts are listed is you're going to have them listed right around that gold point. So you're going to have knockout number 1, you're going to have basically the floor is going to be the market minus 10 points, and the ceiling is going to be market plus 50 points, right? So you're going to have this 50-point range, and in our gold contracts, these are actually $500 contracts, so a 0.1 movement in gold is going to be a $1 movement, but very basically these are going to be 50-point ranges for gold, and they're just going to be offset like this, right? So market minus 10, market minus 20, market minus 30 for the floors, and then the inverse on the ceilings there. So they're all listed just right around the actual listing point, right? They're all listed right around where the market's actually moving. As you go forward and as one knocks out, so let's say in this example, right, with gold has been moving up and down in between these ranges, and then all of a sudden it's going to go all the way up here and it's going to knock out, right? So at that point, knockout number 4 is going to knock out. Anyone in that contract is going to receive their payouts, right? So if you were on the buy side of that contract, you kind of receive the full $500 payout for that contract, which again, remember, not profit, right? That's just a payout. The profit would be payout minus what you paid to get in. The seller in that scenario would receive a $0 payout if this hits the ceiling here. And at that point, a new knockout is going to get listed. So you can kind of see in this diagram, right? One knocks out, a new one comes back onto the exchange and gets listed at that sort of higher point, but still right around where the market is. So at this point, you still have the kind of knockouts 1, 2, and 3 here. You have the new knockout, and it maintains those knockout ranges that allow you to get into a contract either closer to the floor, closer to the ceiling, or closer to the midpoint of those contracts. And again, we sort of have a very similar price settlement trigger, new knockout is listed scenario there. Then at the actual time settlement triggers, they are going to be considered variable payout contracts. So what happens with the payouts, right? With the actual knockouts, right? So if they actually knock out the floor and ceiling, we touched on a little bit, you're either going to get kind of similar to a binary contract, sort of that all or nothing payout, right? Because if you think of what you pay into a knockout contract is basically going to be the distance between where the market is and the floor on the buy side, or if you're on the sell side, where the market is in the ceiling. And we will go into a diagram showing that in just 1 second. If it goes all the way up to the sort of floor or the ceiling, right? Well, the distance between where the market is and the floor at that point is 0. And the distance from the ceiling to the floor, if its floor is the maximum, right? So you can sort of think of it that way when you think of your payouts. Well, if you're on the buy side and it hits the floor, well, the distance for the buy side, the floor and the ceiling, it's 0 now, and the distance between the ceiling and the floor is the maximum level, right? So that's sort of, you're going to get that max payout, right? So one side will get 0, one side will get 500 in the example of gold. But for the time settlement trigger, right? If it goes all the way to the end of the time, right? Well, at that point, the market is still in between the floor and the ceiling. So what the payout will be at that point, and really what your profit and loss will be at that point, is going to be the difference between where you entered the contract and where the final price ended up, right? So if you entered, a gold, let's say a hypothetical, let's say oil contracts, these are around like oil trading like $60, you enter it at, you enter at 60, it's a $50 to $100 knockout contract, it goes up to 65. Well, that's kind of you're going to get a 5-point sort of payout on the knockout contract at the end of the time, right? Because it hasn't actually hit the floor or the ceiling, and you're actually just doing what the or your profit is just going to be where you got in versus where you where the expiration was. And again, the payout will always be the distance between the floor and where the market is and the ceiling or where the market is. And again, we have some examples coming up that will show that a little bit clearer rather than just me using my hands here, even though I do, you should be able to tell I do love using my hands to sort of explain these sort of things. So here we have another example that we still have the gold opening level at 1820, right? So, and it goes all the way to our sort of time settlement. So it didn't hit any of these knockouts. And so the time settlement is going to actually go ahead and trigger these. And you're going to actually get that, that payout based on the time rather than the floor or the ceiling. So, for example, if this contract was, I don't know, let's say 1800 to 1900, that's actually not a real gold range, but let's just use it for an example, 1800 to 1900, and you got into the contract, let's say you got in to knockout 4 back here, let's say, right at this point, and now it's gone down. So let's say you bought it at 18,800, now it's gone down to, let's say this point is 18,600. I should probably put these these points on the actual slide. That's a note for next time. But let's say 1800 to 18,800 to 18,600, right? So that's going to be a 200-point drop. So that would be basically a loss of about $200 in that sort of made-up scenario, right? And basically the loss would be $200, but you'd actually get paid out in, right? So if, let's say the floor again is 1800, the ceiling is 1900, you bought the contract at 18,800 or 1,000, yeah, 18,800. What you would pay would be about $800 to get into that. What your payout would be about $600, right? Because it's down here at 18,600. Therefore, that's a loss of $200, right? So 800 down to $600 is what you would have paid for the actual contract. And when I get onto the if that's not making sense, when I get onto the actual platform and explain it, it should make a little bit more sense where you can go in, use some real numbers, and go through the trade in that way. So the risk and the reward proposition of a knockout contract. So all knockout contracts, and actually all contracts on Nadex, are fully collateralized, right? And really what that means, what that full collateralization means is that both sides at the very beginning of the contract, when you enter in, basically there's going to be a buyer and there's going to be a seller for every single trade that happens on the exchange. You basically come together. If the buy, if it's a $100 total contract, the buy side is 40. That means the seller's putting in $60. Sort of put in the entire value of the contract right there. So that's the full collateralization, right? So that basically what that means is both sides are putting in their entirety of what they're risking at the very beginning of the contract. So all of the money's there up front. There's no margin there. There's no leverage. There's no extra risk built in. It's all going to be that fully collateralized, knowing your maximum risk and maximum reward on both the buy and the sell side on every contract. And knockouts are, of course, so different. So you will know your maximum risk and the maximum potential reward before the trade is placed, right? So if you're on the buy side, your maximum risk is going to be what you paid to get in. And actually, same thing for the sell side. Your maximum risk will always be what you paid to get into the contract. So going back again to our crude oil example from like 50 to 100, if this is a 50 to 100 knockout and I get in at 60 on the buy side, my maximum risk there is going to be 60, the place where I got in, minus 50, the floor, which is 10, right? So that's what I'm paying to get in, and that's also going to be my maximum risk. My maximum reward is going to be the distance it can go up, right? So if I have the maximum, the ceiling price on this contract is 100. I paid 60 to get in. Well, my maximum reward is going to be if it goes all the way up and hits the ceiling for a profit of $40, right? So 100 minus 60 is going to be that maximum potential reward. So it's going to give you that natural sort of profit targets and define a risk control. And just very simply put, it's sort of a take profit, automatic take profit at the top, and sort of an automatic stop loss at the bottom is a way you can think about it, right? Because you cannot functionally go below that bottom level, right? There's no possible way with the contract, and with the way the contract is made up, you also cannot functionally go above that top level. It's always going to be capped at that floor and at that ceiling. Oh, I just got a chat here saying, I can't hear you anymore. It's been about 2 minutes since loss of audio. If you can restart your webinar, but if everyone actually, if you can tell me if you can still hear me, that would be fantastic, because it might just be one person that's having that issue, or it could be everyone. So if you can throw a question in or just a chat saying if you can or can't hear me, and I can try to troubleshoot that. But if it is just you, maybe restart your webinar and we can see if that's working. I guess if I don't see anything come in, oh, hearing's all good. Okay, so for the one person that said that, sorry about that, everyone else. For the one person that said that, if you can just really quick restart your webinar, hopefully that should fix it. But it looks like everyone else can hear me here. So thank you for letting me know. We can still move forward here. So a little bit more on risk and reward. Again, this is sort of what I was just going over. Thank you. I see everyone's putting it in here now. It's just a little bit delay. Thanks everyone for throwing that in here. Moving on, we have our risk and reward here. So just like what we were just talking about, right? On the buy side, the maximum risk is going to be the difference between where you got in and the floor of the contract, right? Because basically what you're paying here on the buy side, you want it to go up, and what you're paying is the difference between here, wherever you get into the contract, and the floor, right? The sell side is going to be the opposite, right? So just like both on knockouts and call spreads, this is actually the same, and I will get into knockouts in just a second. Call spreads in just a second, but it is going to be the same sort of proposition. So on the sell side, it's going to be the opposite. The sell side, the maximum risk you're going to take on, and in fact, what you pay when you first get into the contract is going to be the difference between where the contract is and the ceiling, right? Because the seller is sort of putting in this part, the buyer is sort of putting in this part. And so as a seller, you want it to sort of move in a downward direction. And basically what you're paying is the difference between where the market is and the ceiling. Buy side is where the market is and the floor. And then the reward is sort of the opposite of that. So the buyer potential reward, if you pay this much to get in, your reward is all the way up to the ceiling. And the seller, if you pay this much to get in, your reward is all the way down to the floor, right? So the seller wants it to move down, the buyer wants it to move up. And we have a similar scenario here. So on the buy side, right, you'll be paying basically the buyer will pay the difference here, the seller pays the difference on this side. And so we can go over to this example right here, which is, I think, a little bit better example to explain this. So for gold in particular, every kind of 0.1 movement, is going to be basically $1. It's going to cost you $1. It's going to be $1 profit or a loss as it moves up and down. So if you get in at this 1820 point, right? So let's say the market's trading at 1820, and this from our last example is like the first knockout we were seeing. So the floor is going to be this minus 10 points. So you get in right here, where you're going to be paying is $100 or more. You know, you're going to be paying 10 kind of points, and since 1.1 is $1, it's going to be $100 here because it's a 500 total point range. So basically a 10-point $100 is going to be your risk, and your total potential reward, because it's a $500 range, is going to be this $400, this whole green area here, right? So if you're the buyer, you're paying this difference, right? This difference right here is going to be this 10-point $100 difference in where the market's trading and where the floor is, and on the upside, it's going to be that that reward is going to be where the market is versus where the ceiling is, right? And then we have a similar sell example. So just kind of going back to our examples from before, we're going to look at kind of this. We're going to dive into this one. This one we dived into the last one. And this is going to be another very similar example. So with the fourth one, if we have the market's still trading at 1820, but this contract is trading 1830 to this should actually say 1780, because the floor has to be below the ceiling. So it's actually another note to change this up. So this floor should actually be 1780, not 1880, and the ceiling is 1830. Basically, if you're selling at 1820, you're going to pay between the ceiling up here. So the 1830 to 1820, that's again going to be 10 points or $100. And if you go all the way down, your potential reward here is going to be this whole green area. And it's going to, your potential reward is going to be if it drops from 1820 down to 1780. Which is what it should say. That's a 40-point movement as a potential reward, or a $400 potential reward payout, right? So the capital requirements for this, and this is where you kind of get into why you might trade knockouts in particular, and why you might trade here at Nadex, why you might want to trade a Nadex knockout as opposed to a contract somewhere else, maybe a futures contract if you like trading the indices or the commodities. Those are the more popular ones, and those are actually what our underlyings are. There are the futures markets for those specific asset classes, or for Forex, maybe you trade spot Forex, right? The capital requirements in all of these examples for kind of zero leverage, right, are going to be a lot lesser generally. So you're going to know the maximum risk before the trade is placed. And for example, to get into, let's say you trade futures and you are trading a US 500 contract, right? To get into a Nadex knockout, and actually to get into it and to experience one-to-one movement with the underlying market, you only have to pay what is trading currently in the market versus what the floor is, basically, if you want to be on the buy side. While if you're trading the actual futures underlying, you're going to have a lot more at risk, because you're actually going to, in effect, have to have at risk the entirety of where the S&P 500 is trading to zero. Now, you're not going to have to put up all of that because of something called like margin, and we're not going to get fully into the intricacies of actual futures trading. But basically, the takeaway here is you do get one-to-one movement with the underlying market while trading a knockout, or generally one-to-one movement with the underlying market. However, you're going to have a sort of built-in floor max risk that you can't go through. You aren't going to have this extra leverage you're taking on, right? So you don't have this extra leverage, these extra margin requirements, and you're never going to have a margin call. And I don't know if any of you out here have ever traded with leverage, ever traded with margin, but a margin call is not very fun, right? Because a margin call is basically when the trade has been going against you, and you actually have needed to go put more money in. And in some cases, if you short a market and put more money in than you even thought you'd have to, in order to sort of cover where the market's moved, right? So unlike these other, traditional financial assets where you might have to take on leverage to go ahead and actually get that one-to-one movement, and it's probably going to cost you more capital. Here at Nadex, basically you have a fairly low intensity capital requirement, right? So you can get into a contract, these are generally like $500 ranges, so you can get into a contract for basically $100. You have a maximum risk that you cannot go through, and you still get that one-to-one movement with the underlying market. So this is sort of how we tried to build these contracts and what we tried to build them for using, right? So very low capital requirement, but still being able to get that one-to-one movement and not actually having to take on any real margin risk, right? No margin calls, no actual leverage. What you basically have is this sort of idea of effective leverage because of these floor and ceiling ranges that are built into the contract. So I know that is it's a little bit more it's maybe past the very basics of the contract, but I do like explaining that point because I like getting into kind of why we built these and why you might want to trade these as opposed to trading in the underlying market or as opposed to trading another contract on Nadex, as opposed to trading a call spread, which I will now go into a little bit. But it really is in my why I would trade them if I actually could trade on Nadex, but why we tried to build them was basically giving people the opportunity to trade them with that low capital requirement while getting that one-to-one movement, but without sort of over leveraging yourself on that. I see another question here. Yes, we actually are in Chicago. The question was, are you in Chicago and do you offer one-on-one trading? I do not offer one-on-one trading, training. These webinars, though, I do try to answer the questions as you can see as they come in. And if you do need some more help with a very specific question, you can go ahead and call us or go ahead and you can go ahead and email us or live chat us with those questions, and they should be able to help you out. But if you do have any questions on this webinar right now, you can go ahead and throw them in, and I will do my best to answer them. So moving on to call spreads, and we're going to go over call spreads very quickly here because the concept of call spreads is actually fairly similar to knockouts, right? So a lot of what we just talked about with knockouts are going to apply to call spreads as well, but there's one major difference. So with the call spread, you have the same sort of thing as the knockout. You have a floor and you have a ceiling, right? The floor price, you're not going to be able to go, the actual price of the contract can't go through the floor, and the actual price of the contract can go through the ceiling. However, I will say, so the value, the similarity is, it is going to move similar to the underlying market. However, you are going to see that there are times when it doesn't move with that actual one-to-one market movement. And this is kind of on purpose with the contract makeup. And it's because of something called optionality that I will explain in just a second. But the major difference that you want to know between call spreads and knockouts. So with the knockout, if it hits the floor and it hits the ceiling, you're knocked out of the contract, and new knockouts listed, and you keep going. With the call spreads, if the price of the underlying market moves above the ceiling or below the floor, the contract continues to go, right? There, you are not knocked out at that point. Your losses and your maximum loss, your maximum profit, your risk and reward are still capped at that floor and the ceiling. However, the contract does not stop if it goes above the ceiling or below the floor. The only thing that expires in a call spread contract is getting that time expiration that we talked about in the knockouts, right? So there's no price triggering expiration. There's just the time when it gets to the end of the contract, right? So basically what you are getting here, and as you can sort of see, I'm talking about the differences before we get to the slide. So it only triggers at expiration, and the volatility and the time to expiration is going to impact the price of the call spread. So that's why you're not with the call spread. It's going to have that one-to-one exact movement with the underlying market, because you do have this sort of optionality. And basically, the way you can think about this is with the knockouts, you're trading one-to-one, and if it hits the floor, it hits the ceiling, you're out, the trade's done. While with the call spread, you're sort of this kind of premium that's built in, this optionality premium, is because you're sort of paying extra for the opportunity to be right. So you can think of it as, on a knockout, it goes up, it triggers, it hits the top, you're knocked out, the trade's done. But on a call spread, let's say that you got it on the buy side, right? I got it on the buy side, I paid $100 for a $500 total range or something, and oh no, I was wrong, right? It didn't end up going up, it ended up going down, right? Ended up going down, and it's gone way through the floor. Well, on a knockout contract, I'd be knocked out. I would take my $0 payout, $100 loss on that contract. But with a call spread, I'm going to be able to actually stay in that contract until whatever expiration time is. So let's just say it's on Friday, and this is still a Monday. So actually, at this point, if it's gone all the way below this floor point, I have all week for it to kind of come back up and potentially come back in my favor, right? So you kind of get the time to be correct on the call spread. So they can come back up, they can come back into it and start trading again inside the actual ranges. and potentially it could start moving back above where I actually bought the contract at, and I can potentially still profit at that, or maybe just not lose as much. I can limit my losses if it comes back up, but your losses are still absolutely limited at the bottom and absolutely limited at the top by the ceiling of the contract. And this is just sort of a quick rule, and I will go into the call spread and the knockouts kind of differences and similarities just when we actually get in the platform, which I do want to hop over to that real quick because I want to get in, want to do some actual examples. This is just something that's super important with call spreads, with knockouts, and actually with binaries as well, all the contracts in Nadex. We've talked a lot about how these expire up to this point. You don't have to stay in these contracts until expiration. You get out at any point, and especially with the knockouts and with the call spreads as well, because these are moving, fairly closely with the underlying market. Oftentimes, it can be a good idea if it messes with your trading strategy to get out of these contracts before expiration and either lock in some of those profits, right? Even if it's not a ceiling yet, you can lock in some of the profits you have, or if it's going towards the floor, you don't have to take that entire, maximum loss that you have on the trade. You can limit some of those losses for the contract as well. And so that's with knockouts, that's with call spreads, and that's actually with binaries as well. You never have to stay until expiration. You can exit early as long as there's someone in the market willing to take that contract off of you. I have a question here right before we jump over to the actual platform. It says call spreads are a little bit more riskier than knockouts, correct? So that was the question, and I don't think I wouldn't say they're riskier. No. They're just different because the actual risk reward proposition of the call spread and knockout are going to be the same or similar, right? You can get into a knockout and a call spread. Let's say there's a knockout and a call spread trading at the same exact levels. Let's say 50 to 100 is a call spread and 50 to 100 is a knockout. And you get in at 75 on both of them. Well, inherently, the risk is going to be the same on both those contracts. You can lose 25, you get into 75, and you can gain 25, right? So they're not inherently riskier. Neither product is inherently riskier than the other. You can lose the entirety of what you're putting in. You can gain the maximum profit as well. So they're not inherently riskier. And in fact, there can be times when if you get into a call spread, it can come back up and get back into your favor, and you can actually limit your losses. So, and that way, maybe they could be less risky, but they could also be more risky. You could actually end up locking your money into a contract for a little bit longer time, and still, the market doesn't come back up. So that is a risk with call spreads. So it's not necessarily inherently more or less risky between the contracts. I think there are just different kinds of risk, right? While with the call spread, you have maybe time to be right. You also have time that your money can be potentially locked up while you're waiting to be right if you don't choose to exit the contract at that point. I would say either of them are inherently more or less risky. They're just different for different sort of trading strategies, and they while the absolute risk is going to be similar on both sides, they can have different types of risk, if that makes sense. Excuse me. So we are going to go ahead and jump into the platform real quick. You see another question here coming in, so I will go ahead and read through this while I'm jumping in the platform. I'm just going to go to wonderfulnadex.com and log in my demo here. Excuse me. Okay, so the question here is, I was late in arriving. Maybe you've talked about this, but put spreads, which I tend to use, but are put spreads written only exercisable at expirations? So I'm not sure if you're talking about put spreads in terms of the put spreads written only. So if you're talking about writing put spreads, like writing a traditional option contract, that's not something that you can actually do at Nadex because these are sort of fully collateralized contracts that are sort of listed already. But if you're talking about that in terms of taking on the sell side of a call spread contract, which is similar to being long in a put spread, I'm never sure, if the terminology is sort of meshing because there's a lot of terminology out there in the finance world. But basically, you're talking about being short on a call spread. They're not only exercisable, like you can get in and can get out early, but in terms of actually writing option contracts, which I'm not going to get fully into it, but in terms of actually writing option contracts, you can't actually do that on Nadex. If that answers the question, and I'm sorry if it doesn't. I'm never sure when getting into the traditional options terminology, sort of what different people are using. I'm going to log into my Nadex account, and we're going to actually get into the platform itself here. So everyone should be able to see the platform itself. I have another question coming in. What is a discovery call? In terms of Nadex, we do not have discovery calls. I'm not sure exactly what you would be referring to, but if you want to explain that a little bit more, what you're asking, maybe I can give you a little bit more background to that. So let's jump right into the platform here. So as we jump into the platform, we have on our top left-hand side of the screen, we have our binary options, call spreads, and knockout contracts. For the, we'll start with doing a knockout example. So you can click across the top here. You can see all of the different market asset classes that you can trade on Nadex with these. And let's jump into an indice because the indices are fairly popular with trading at Nadex, and let's do US 500 contract. So as I actually click into the contract itself, I click on the US 500, I can see my 4 knockouts come up here. And one thing you will notice, and I know we'll kind of compare this and contrast this with call spreads. With the knockouts, you'll notice that these are trading fairly tight spreads, and they're all trading right around where the indicative underlying market is. So you can see this is sort of where the market's trading, and this is where the 4 knockout levels are trading, and they're all trading basically at the same bid ask, right? Generally, they're trading at the same bid ask. As we click into one of these, we're going to get these coming up on our. Let me take off. Let's take off all our drawings here, and I'm just going to try to give these. There we go. You can see these a little bit better. So I just clicked into one of these, and now I have my my knockout kind of contract both up on our chart here in the middle of the screen, and on the right-hand side of the screen we have our deal ticket. You can see here on the left-hand side of the screen, I have my 4 different ranges that are these ranges right here, and I can kind of click through them, right? So it's overlaid directly on the chart, so you can actually click through them and see, okay, this is sort of, this, you can visualize how close the market is to that bottom, and visualize how close it is to that top or ceiling level. You also are going to be able to just choose buy or sell here at the top, or you can choose them any of these places at the top right on the deal ticket itself, right? So you can choose your buy or your sell side. So let's get into a buy side contract here real quick. We'll get into a buy side on this 4410 to 4460. So a lot of the times when I'm trading these on the demo, and just a general strategy I like to use, and this is by no means a strategy you need to use, but a lot of times I like to get them somewhat near the bottom of the contract, the floor of the contract if I'm trading on the buy side, just to that a strategy I like to use is you pay a little bit less, you have a lot more upside. Of course, while you pay a little bit less, you're risking a little bit less. You have a lot higher chance of that going down quickly and hitting that floor. So you do need to always balance that sort of risk reward in your head, right? But we can get into this contract, so we can see, okay, we're trading right here at about 44.17, and this is about 44.10. So if I were to get into this at, and right now we have a limit order selected, and I do like to show this just so you can see it very kind of clearly here. So 44.10 to 44.60, that's a 50-point range. And you can remember earlier when we were talking about gold that that I was talking about how each 0.1 movement was $1, and that's actually going to be the same for the US 500 contracts as well. So with these, something that's always fairly important to know is the kind of tick size, right? So the tick size of the underlying market. So this contract is going to have sort of one-to-one movement, but every 0.1 movement in the underlying is going to be $1 up or $1 down. So for this sort of 50-point range, if you do 50 divided by 0.1, you're going to get a 500 total dollar contract in this 50-point range, right? So because there are 500.1 potential movements inside of this 50-point range, and that's $500. That's another way you can think about it. So I'm going to get in on the limit here, and let's do. I'm going to just try to do 44. If I were to get into 44.17, I'm trying to keep these kind of whole numbers here. I'm trying to give these sort of whole numbers here for this, just to make it a little bit clearer. So the difference between 44.17 and 44.10, that's going to be 7 points or 70. 7 whole points, 70.1 ranges, $70, and you can see that here by the max loss. So we have our max loss here, that's going to be 70, right? So 44.17 minus 44.10, that's going to be 7 divided by 0.1, if you want to do it that way, is going to be 70. And then on the upside, right, 44.60 minus 44.17, that's going to be 43, right? Just quick head math, it's going to be 43. 43 divided by 0.1, 430. So you can see this very clearly here, right? 430 plus 70, that's going to add up to 500 total points. And you can see very clearly before you get into the contract what your total max loss is going to be, right? Because remember, it's just going to, your max loss is going to be where you get in to the floor, and the max profit is going to be $430 where you get into the ceiling. Now, this market's moved a little bit since I've been talking, so I'm actually going to try to get in using a market order real quick. We're going to place that. And we can see here, I actually got it at a price at 44.13. No, I got it at a price at 44.14. So if we want to go back to the limit here, I like to do these on the limit because you can actually see, you can move the price up and down and see where your profit and loss is going to be, while the market order is going to get you in the best available market price being offered. So we can see here that I got in at 44.14. That means basically I paid $40 on this contract. That's going to be my maximum risk on this contract, and my maximum potential rewards are going to be $460. Now you can also see that I got in while this market was moving down, and we're getting real close to a point. So we might actually get to see a knockout here because it is moving down, and it's getting real close, and we actually might be able to see on this webinar in real time. I actually hope we do get to see the sort of relisting process, how this works, how a knockout actually knocks out on the bottom side. Of course, as I actually say that, I have jinxed us in the market is moving back up. So we'll keep an eye on it. Maybe we get to see it during the webinar itself. But we can see my trade down here at the bottom. So I want to real quickly run through the sort of open positions window. I do have another question here. It seems that the floor and ceilings are always changing. So the floor and ceilings are always going to be static for that particular knockout, right? So this knockout, while I'm in this is always going to be 44.10 to 44.60, right? That's going to be the makeup of the knockout. However, if this does knock out, if it does hit 44.10, well, yeah, then that knockout's not going to be here anymore, and there's going to be a new one listed, right? So while these knockouts are listed, as I like click up and down, you can see these are always going to stay until they get knocked out, and then they won't be here anymore. But while they're here, that floor and ceiling is not going to change. The price in the middle is going to change. The floor and ceiling is not going to change. So we have basically we have the contract name. You can see 44.10 to 44.60. We have the indicative market, right? So the indicative market's where the market's moving, and you can see as it moves up and down, sort of to where we got in. You see the expiration as well. So this expires Friday at 4:15. So tomorrow at 4:15 p.m. Eastern. And I can see I have a day and 3 hours left. So if it doesn't hit the floor, if it doesn't hit the ceiling by tomorrow at 4:15, I'm going to get an expiration due to time. We have our position here. This is +1. So a +1 or a blue in the position is going to signify a buy side contract. It means I'm on the buy side. I want it to move in an upward direction, right? The average price I paid, I only bought one, so it's going to be 44.14. If I had bought multiple of these at multiple different prices, that's going to be sort of the total average price. Because I just bought one, it's just telling me this one contract I paid I got into it at 44.14. And you can see, you kind of quick mental math, 44.14 minus 44.10, that's a $40 cost is what I paid to get in. The market currently is trading at 44.13. Now this is 44.13.50. It's going to move up and down because that's what the market is currently trading at. One important thing to remember with both the knockouts and all contracts on Nadex, the current you see displayed in this field right here is always going to be the opposite of the side you got in on, right? Because so if I get on the buy side, the current market price displayed is always going to be the sell side market. So you can actually see as this moves up, my current's moving up and down. If I were to get into this on the sell side, right? If I were to get in for a sell side market and have a short position on this, the current market price is going to be displayed as the buy side price, right? The reasoning for this is when you actually, if you want to exit this contract early, you need to basically get out at the opposite of what you got in. So if I bought to get in, I sell to get out. If I sold to get in, I buy to get out, right? So that's going to be the pricing, and therein you see the profit and loss, and the profit and loss is going to be if I sold out right now, the profit and or loss I would receive. And the profit and loss, and you can actually calculate it pretty quickly, and this is what's pretty easy. I got in at 44.14. When this was 44.13, right? That's going to be a 10-point movement in a downward direction. I'm going to be at a loss of $10. Pretty simple, pretty self-explanatory on how these move up and down, right? And that's why I think knockouts are maybe a little bit simpler to understand, because they do have that sort of one-to-one market movement, and they get that one-to-one market movement because of that hard knockouts on the top and bottom. It kind of allows them to do that. And as you can see, as it moved back up above where I actually got in, I'm starting to actually make a profit on this trade. So that's going to be the actual knockouts. Now, really quickly, let's go through and just see super quick what, let's see, we'll do a US Tech 100, I think. No, let's do a US small cap. The Tech 100 trades in 0.25 increments, which makes it harder for our examples a little bit. So let's go back. Let's do a small cap here contract, and let's see what happens on the sell side. So I just brought up a sell side contract. It's going to be this top one. And so if I get it on the sell, this is just to show that it's going to be the opposite of buy, right? So on the buy side here, if it's 246.80, let's just do an even number here. Let's do a 2047. Actually, let's make it even easier. Let's do 2045, right? So I have the ceiling of 2056, and I have a price right here of 2046, right? I'm going to have to pay $400 to do a price of 2046 for a maximum profit of only $100 on the buy side, and the reverse is true on the sell side, right? So if I agree to the sell, you see it's the exact inverse, right? So if I'm 2406 on the buy side, I was $400 was my risk, what I paid to get in, and $100 was my potential profit. On the sell side, it is the exact opposite. It is $100 as my maximum potential risk, because remember, it is literally just we're just inverting these, right? So for the sell side, this is going to be my risk. This is going to be my reward. For the buy side, this is going to be my risk. This is going to be my reward, right? And you can see that as we kind of move from back and forth. So I'm just trying to use the example of 2046 because it gives us that nice sort of round 100 number. So 2046, if I'm there on the sell side, I'm risking 100 because it's about 100 point from the top. 2056 minus 2046, right? And then the total reward is 2046 to 2006. So it's a 40 point $400 bit potential reward there. And then, same on the buy side. If I go back and choose 2046, it's going to be the exact inverse. And so therein, you can also see sort of that full collateralization of the contract, right? Because on one side, the buyer is paying 100. On the other side, on one side, the buyer is paying 400. The other side, the seller is paying 100. That's that whole $500 pot sort of paid in at that point. And then, as it moves up and down, either the buyer will gain money, the seller will lose money, or as it moves down, the seller will gain money, the buyer will lose money. So we can get in just really quick. I just wanted to show sort of a sell side contract because sometimes it is a little bit harder, and I'm just going to get into the market price just to super quickly get in. But again, so we can see here, this is my sell. I have this -1 shown, and I got it at 2046.7. And so we can see the same sort of thing. As this moves up, I'm going to be losing money. As it moves down, I'm going to be gaining money, right? Because if you're on the sell side, you want it to go down. So you can see it kind of in real time, it's 2046.7. If it's going down, right? If it goes down to 2045.7, I'm going to be up $10 at that point, right? Because I want it to go down, and if it on the buy side, I need it to go up. So pretty simple there. We're going to get into the call spreads real quick, and what I want you to look at. So I'm going to go look at some US 500 call spreads, but I want all of you to notice before I click over the call spreads, just look at the pricing here for the knockouts. So look how with the knockouts, all 4 of these are priced basically the exact same. They're all very tight, and they're all right around where the indicative market's pricing. So we have like 44.15, and as the indicative moves up and down, these are the buy and the sell are like the indicative is going to be here, the buy and sell are generally going to be right here, right? So right above, right below the market. As I go over to call spreads, what you'll notice is that this is not the same for call spreads. So let's go over. Let's go in and let's do a US 500 contract. Let's do one expiring at 2. Actually, let's do one expiring a little bit later on. So, but as you can see here, when I actually click on they're different ranges, but they're pricing differently, right? They're not like the knockouts, where all the knockouts are pricing basically the same, and they're all pricing right around the underlying market. These call spreads are basically all priced differently, and they're not all pricing around the underlying market. And this is where we come into what I was talking about earlier with that concept of optionality and that concept of time value, right? Because these don't knock out at the floor and at the ceiling, you get this time value where the actual pricing for these is a lot more variable than with the knockouts, right? And so I'll click into one of these, and as you can see, as I click in, actually looks like the market's moved fairly significantly since these were listed. Let's actually do a 2-hour because these should be a little bit closer. The markets have been moving a lot today, so these should be a little bit closer. Right now I'm moving fast, but I'm just trying to really like make the chart good so you can see what's going on here. Let's choose one. Okay. So first thing you might notice actually on the chart itself is the knockout of the call spread ranges are a little bit shown a little bit differently. We try to visually differentiate them so you always know if you're trading a knockout, you're trading a call spread, because otherwise the actual naming convention and that sort of thing is fairly similar. And so you'll notice here actually, so when I am in this call spread contract, the underlying market is trading pretty close to the center, right? We're pretty close to equidistant between the ceiling and between the floor. For a contract like this, you can see that 44.1418 on the sell side, 44.15.1 on the buy side, that is still trading right around that indicative price, right? So it's fairly close to that indicative price when the contract's in the middle of the range, right? It's much more like a knockout, because you basically have an equal amount of distance to move up and down for the contract. But as you start to move up and down, and let's look at one kind of up here. So this one, as you can see, this contract's still alive. You can still get in, you can still trade this contract. However, the market is not in there, right? The market is way below the floor. You would never see this on a knockout, right? Because the market for knockouts, as soon as it goes below the floor, that contract's knocked out. However, with the call spreads, this is the main difference. The underlying market is trading far below the floor. However, you can still trade this. But what you will notice with the pricing though, the underlying market here is like 44.14. The buy and the sell side are sitting around 44.22, almost 10 points above where the actual underlying market is. And this is because of that underlying this is because of that optionality, because of that premium is sort of being built into the pricing of the contract by the market makers that are providing the pricing. They are pricing these, and they are kind of building in this premium because you need to pay more for this premium because if you got in down here, right? Like let's say I just got in down here and this was just pricing like at the floor of the contract. Well, there's basically no reason for anyone to ever take the other side of this deal, right? Because like if we just think through how this contract would play out, let's say in a hypothetical world that this did price like a knockout, and if this was underneath, right, if the underlying market was underneath the floor, I would basically just pay the floor price, or maybe like $1 over the floor price. Well, that wouldn't really make any sense for the person on the other side of the contract. So if I were, for example, paying like $1 because the market's trading underneath, well, I have basically unlimited upside because I'm paying $1 for the option for the market to just come back and just go all the way up, right? I'm basically paying nothing, while the person on the sell side is putting in all the risk and basically getting zero chance at any sort of profit, right? Because they would be putting in like $499, and they would have no chance at having any profit because all they can do is lose. All they can do is have that market go all the way back up into the contract. Now on a knockout, that is a lot more likely to be pricing like that, because as soon as it knocks down, well, that it's kind of sort of caps the risk reward proposition right there, right? The seller might want to do that. The seller might want to get in at $490 for my $10 because it just has to move here and I'm out. On this, there has to be some sort of premium priced in. There has to be some sort of premium for being able to get this time value for upward movement. So I'm basically paying, if I were to get into this contract, I would need to pay $44.23. So I'd be paying about $30 to get into the contract. My max profit would be $70, but I don't even start getting a profit here until it gets back above $44.23, right? And so that is why kind of you will see this extra built-in premium to the call spreads, why it doesn't price with this one-to-one movement. And even if it's in sort of like not exact one-to-one, right, you can see it here too, as it moves away from the center. So we have our center contract here, it's priced right around the market. Now it's priced, a little bit above, because again, if I just got in right here, well, there's not much reason for a seller to take the other side of the contract. And so it's priced a little bit differently, right? I'm paying a little bit more, but I do have that, I'm paying basically for that premium to be right, to be correct. I'm paying for that time value for the contract to move in my favor potentially. And so that's why the pricing is a little bit different with the call spread, but I think I've harped on this quite a bit. Let's actually get into one of these call spread contracts. With the call spread contracts, you'll notice we do have a lot more different expiration times for these. And that's sort of needed, right? With the knockouts, you kind of only need one expiration time because it'll sort of knock out and the contract will be over. And you'll get to get into a new one, while the call spreads you might need a little bit of time to actually be correct. Sorry, I did miss a question here. So there's a couple. Actually, let me just place this trade real quick, just so I can get to it, and I will grab these questions just at the exact end here. I know we're right over an hour, so I just want to go through these and then go through these last few questions, and we'll call it. Thanks for sticking around. Actually, just didn't even realize we're going over an hour. So much fun just talking about contracts. So really quickly, I'm going to just get into a call spread just to show you how it works. So it's going to be very similar, right? And let's do just 44.15 just on the dots, just so we can see. So this is a total price of $100 contract, right? So we have our ceiling here at 4420, our price, the floor at 4410. That's a 10-point or $100 contract. And one thing to remember, all of these we've talked about have been 0.1 pick for dollar. Not all contracts are like that, so make sure you know what yours is when you get in. But for this one, it is. And basically, if let's actually get down to like 44.14 so I can show you. Again, it's the same exact pricing sort of model for when you're actually getting in. So if I'm 44.14, I'm 4 points above the floor. 44.14 minus 44.10 is 4 divided by 0.1. That's $40. I'm paying $40 to get into this contract if I were to get it at 44.14. And the maximum profit would be if it hits the top at 44.20 and goes up and expires here, and not exactly expires at the top, but if it were to expire above that point at the expiration of the contract. So I can get into one of these. I'll do a market order. We'll just get in real quick, and you can see very similar, and it's all going to look very similar. You want to just make sure you see here. This one tells call spreads, and you can see the duration and the similar up and down movement. So that is really going to be the majority of the webinar here. There are a couple questions that were coming in while I was doing this, and I'm going to answer right now. If you do have any more questions, please throw them in the chat right now. I will get to all the questions that are being asked before we we wrap it up here today. But I do hope everyone has learned just a little bit today. And so let's go over. So one of the questions we got: are the knockouts or call spreads stuck to a particular time frame, like 1 hour, 4 hour, etc.? Okay, great question. I think I did just accidentally touch on that, I think a little bit after you asked that. So so for the knockouts, all knockouts are going to be weekly contracts, right? They're all going to start Monday morning, and they are all going to expire Friday afternoon. It's different for each market, but the exact expiration time, but generally Friday afternoon at some point in the afternoon when the underlying market sort of closes. But for the knockouts, you are going to have the reason they're kind of only weeklies is because you can trade in, you can trade out, and because you're actually in practice, a lot of them won't go that whole week, right? While the duration is technically going to be a week, most of them and almost always within a week time frame, that the ones listed, the first ones listed on Monday, almost never get to the end of the week without knocking out at least once, because that's sort of the market's gonna move up and down. And so while functionally, yes, they are week long, in practice, generally they're not going to last the entire week, right? They're going to knock out sometime in that period. While the call spreads, yes, they're going to have different expiration times. So you can see here on the left-hand side, we have these sort of rotating 2-hour ones throughout the day. So actually, as we were talking, one of them expired and a new one came up. So we had this 12 to 2 p.m. was the one we were looking at. We have a 1 to 3 p.m. And then we also have dailies as well for the call spread contracts. So that's gonna be that one. And then let's see, the other question I have here: is this the stock we saw drop last week? That large red candle. Oh, yeah. So for anyone that was on last week, it seems Thursday at noon we really have a lot of market movements. I actually believe last week we were looking at a Forex contract. So I don't think it was the same contract. So just kind of goes to show you, so many of these markets can be volatile, right? So if anyone wasn't here last week, I think we were doing I don't know, maybe Euro dollar, Aussie dollar example on the binary options, and we got into one and we just had like a 5-minute candle that dropped it just went through the floor, right? It was it was like one of these, sort of like one of these bad boys back here, sort of a huge massive red candle as soon as we got in the contract. So I do think that was a different market last week, because these are the index markets, and I think last week it was a base dollar Forex pair, I believe. Okay, so yeah, if you do have any other questions, throw in the chat. Just for this last little bit, I'm going to throw this slide back up here. There's a way to do this. Well, we're just going to go all the way through the end. Keep throwing your questions in the chat if you do have any, and I will go down and get to those in 1 second. Okay. Thank you all for coming to this webinar today. By the way, I know I am a little bit over. I think it's about almost 10 minutes over at this point. So we will wrap it up here. But if you do need any help, if you do have any questions that you're not asking here that you come across maybe later on, you can go ahead and contact us. Either email us at customerservice@nadex.com. That would be better for more long form questions. If you do need a more immediate response, though, you can always live chat us. If you go to the sort of contact us section of our website, there should be a little live chat bar at the bottom right hand corner of the screen. And that, if you have maybe a more simple question or something that you need more instant access to, you can go ahead and pick that up there, and that's maybe going to be a little bit faster. If you do want to leave us, go ahead and leave us a review, trustpilot.com. If you are liking trading at Nadex, you can certainly go ahead and do that. Leave us a review, it does help us out. And here are all our socials as well: Twitter, Facebook, Instagram, all the good ones, all the big ones, YouTube, LinkedIn. This webinar will be up on YouTube probably in a couple hours. Generally about that time. So go ahead, if you missed any part of it, if you want to go back to any of it, you can go ahead and watch it on YouTube there, as well as a lot of other videos that we put out. I do a webinar every Thursday. Those are all going to be on the YouTube channel, as well as a lot of more short-term videos if you don't want to spend a whole hour. And we do have some other content, people that put out content, Nadex as well, if you prefer listening to someone other than me. Like I said too, I do a webinar every Thursday. So last week was binary options. This week was call spreads and knockouts. Next week, I believe, is an overview of the platform. So we just go real in depth into the functionality of the entire platform. And then the week after that is going to be in depth into the charting functionality of the platform. And we sort of rotate that. So every week we do that, and then every month we rotate. So this should be back in. We do have one more question coming in. Is it possible for you to increase the size of your screen font so we can see the figures on the side margins and graphs? Good question. I haven't been asked that before. Potentially. You know what? I will. Yeah, the question was, can you basically increase your screen font so we can see everything? And I'm assuming you were talking about on the platform itself. I will have to try to check on that. Because it's probably coming over your screen a little bit more compressed than it is on mine. So I'll try to see if I can't do that. I know there is a way to do it. In fact, on the platform, but it might kind of scrunch everything else up. So you know what? Let me play around with that after this webinar and for future ones. That's actually a very good point. So thank you. That's really good feedback. Might try to make the figures on the platform show up a little bit more. Thanks for that bit of feedback. Just got knocked out at 44.10. So someone I think was trading the same thing we were trading, and actually, yeah, we can do that. We can go back real quick, and yep, looks like we did just get knocked out at 44.10. That knockout's not there anymore. So you can see that we got knocked out to the bottom side on the knockout contract, and that knockout won't be there. There'll be a new one up. Yeah, so we could see that it was 44.60 to 44.10 was the one that we were in, and now rather than that one being there, one was listed down here. So now there's a 43.70 to 44.20, and that 44.60 to 44.10 is no longer there. So you have to see a little bit of how those knockouts work. All right, so if there's no further questions, I may just give it one more minute. I know we're really about 10 minutes over on this webinar now, so I do want to cut it off here in a second. So I'm not seeing any other questions come in. I just want to say, everyone, thanks for coming and hanging out for the last little over an hour with me on this webinar. I love doing these. I love talking to all of you. I love when you guys are asking questions. So thanks for coming, asking questions, and just getting to chat about some products that are fun and I think interesting to talk about. Best of luck to all of you in your trading. I hope you're still staying out well there, and yeah, hope all of your trades go well. Have a great rest of your day, everyone.